We're nearly there, nearly there. I'm Nick Pasco, I'm at Blevins Franks, and I'm talking to you specifically because from France I spent 14 years in Bergerac, and I moved back about 18 months ago, which I know might not be a great precedent, you're all on your way out, but that was a decent stint over there, so I'm going to run you through some of the key points on moving to France and what to expect there. So just 2 minutes on what we do and how we do it, and then we'll get stuck into France. That's where we are in Europe. Well, wrong. That's where we are in France. We're in London in the UK. That's where a lot of the tax advisors are. That's our headquarters. But you see, we start up at Niort in the Charente-Maritime and work down through Bordeaux and Bergerac and down along the coast. There's an office in Monaco as well. So most of those offices are dealing with. Well, they're there so we can have regular contact with clients, and that's usually because we're giving ongoing financial planning advice, wealth management advice, the tax planning, if you like, the pre-departure advice is usually done before, and that's done in the UK. The group's been around about 44 years, started as a accountancy firm, but yeah, 44 years in operation, and you can see there's 22 offices in continental Europe. Plus London, and there's lots of families, as we call it, so households, families that we look after. A big part of the business is the wealth management side, but it all starts at tax, and we're now looking after exchange rate dependent, but about €2.5 billion of client money. So it's tax-led, and I think our job, and hopefully the value-added bit, is joining up the dots between countries, because you will, and today's a good example, you pick up bits of information, you get some direct answers to some questions, but it's actually still quite tricky to do, well, how does that actually apply to me? And now I've got another fact, but what does it mean, and what does it mean in both countries? And that hopefully is where we can join the dots for people, especially where you've given yourselves a little bit of time in advance and are doing this as you clearly are before you've actually gone. Surprising how many people from my time in Bergerac would contact us after their first year to work out how it's all going to apply to them. Unfortunately, at that stage, we can only tell them how it's going to be and not what they could have done. So authorised in the UK by the regulators here, FCA. We actually have what's called a passport. One of only, not very many firms have it, where we can actually deliver UK regulated advice actually overseas. If you've got investments, got an IFA over here, you move to France, you will have to physically come back to the UK for that meeting unless they've got a passport. And frankly, unless that business is specialising in overseas clients, they're not going to go through all the hoops involved in doing it. So you will have to physically come back to get your advice in the future. Moving to France. Right, I'm going to go there briefly, quickly, get it out of the way. Brexit, what do we know on Brexit? Have a look at the website, we've done some articles on it. I will. There are a couple of key points. I mean, when this whole thing came up, there are a couple of questions that kept coming up, and I will answer what we know about those, and it was really about what's going to happen to my pension, or specifically my UK state pension, and what's going to happen with my access to healthcare. Those are the two questions that came up more than anything else. We know a few things now. So until 31st of December 2020, we still have our well, it's a right to roam, isn't it? We have a right to, we can move to France. There's no issue there, and we're going to be able to do that from March next year, which is the first big event. They will actually be able to apply for things. So when I first got to France, it was 2003. It was just coming to an end, but you had to have this the residency, a carte de séjour, which even as a UK national, you had to have one before. That will come back in. So there is a little school of thought which you'll be able to apply for one of those again from March 19. You won't need one, but you'll be able to apply for one. Maybe that will be a good idea to apply for one so that come January 21, you'll literally be renewing your card. You won't have to go through the process of application. But if we just think about this sensibly for a minute, and this whole fear, just to allay fears about will I be able to move, will I be able to become resident there? Yes, you can move to France now. You don't need to be an EU national. If you're from South Africa or Australia or Canada, you can move to France. You simply need to prove, and it's not terribly difficult, that you're not going to be a burden on the state from the day that you arrive. So it's not suddenly going to be off the cards that you can move. You don't need to rush out there now. But there will be a requirement in the future for a carte de séjour or residency card. What does it mean? What is becoming tax resident? You will become a tax resident in France The day after you arrive with the intention of remaining in France. So you don't get 183 days, 6 months worth of grace period whilst you don't have to pay taxes until you're deemed resident after 6 months. If you go with the intention of remaining, the next day you're deemed to be a tax resident. So the dates are, 183 days, 6 months is a key one. If you're spending more than 6 months of the year in France, you'll become a resident. If you're one of a group of people, it's not many people, but some want to retain their UK residency or residency outside of France, but spend as long as they can in France. There's one little potential pitfall, which is it's not quite as straightforward as spending, for example, 5.5 months in France and you'll never become resident. You can do if you don't spend more time in any one other country. So, for example, somebody that spends 5.5 months in France and then goes somewhere warm in the winter like South Africa, spends a couple of months there and spends the rest of the time in the UK, where will they have spent most of the year? France. So you've got to be a little bit careful. It's not quite so black and white that France will be looking at, is it your main home, is your centre of interest France? But the basic rule, and one for the vast majority of our clients, is that you're moving, you're selling up in the UK, France is going to be a main home. Tax resident the day after you arrive. What do you need to have a look at as sort of admin points, if you like? You can let HMRC know that you're leaving in advance. You don't actually have to, but it's good policy to do so. You can fill in a form called a P85, slightly different form if you're self-employed. And that just lets the UK know that you're on your way. A good contact point for anything to do with HMRC, pensions as well. The international department is based up in Newcastle, and they're very user-friendly. So if you've got questions on what's going to happen to your pension, your eligibility, etc., and a contact point would be to get hold of Newcastle. Do take advice on, for example, investments and pensions prior to departure. One, you'll want to know how they're going to work when you're overseas, but also you don't want to miss any opportunities before you go. So what will those be? For example, do you take your 25% out of your pension, which would be tax-free in the UK, or do you leave it till you're in France? Do you use capital gains tax allowance? France doesn't have a capital gains tax allowance, so it would be a good idea to take advantage of what you can before you go. ISAs, for example, are free of tax in the UK. They're not in France. France will just look through them and say, well, you've got stocks and shares in your ISA. They'll be taxed as stocks and shares. So it's just that sort of again, pre-departure planning to make sure that you do. Selling your main home, that's free of tax in the UK, but some people might be moving to what was a holiday home, for example, and think, well, I'll let my main home for a couple of years and then sell it. Fine, but be aware you won't be selling it as your main home. So you might have a capital gains tax liability that you wouldn't have had otherwise. France is actually pretty good for capital gains tax if you've owned a property for a long time. It was touched on earlier, but it's unless it's changed since I've come back. I mean, it was 23 years for capital gains tax, 30 for social charges. Yeah, okay. So and actually, I mean, France and tax havens are not words that are often in the same sentence. But we've had cases of people who've built up buy-to-let portfolio and they've owned them for donkey's years, and we've said, well, don't sell it now. As a UK resident, move to France and then sell it, because the tax bill will be a lot less for you in France. But again, that won't be many people that drop into that happy situation. After you've arrived in France, good local PR, go and see the mairie. It's all nice and local, everybody knows your business, and go and see the mairie, say that you've arrived and that you're here. Is there anything that you should do? There probably won't be, but again, it might be something simple like changing the tax on your property from being a second home to your main home, for example, something along those lines. If you go to the tax office, they'll say, hello, come back next year. There's nothing to do. End of May is the normal filing deadline. The tax year is very sensibly the calendar year, unlike the UK. So if you do go to the tax office on arrival, there's actually nothing practical you can do. You have to wait until next year. Healthcare is probably the main thing to crack on with, is getting any local application that you need to get into the system for healthcare. I'll touch on that in a second. So there is a little bit that you won't be able to do. Is a little bit of hurry up and wait to start with. You won't get your French tax number until you've filed your first tax return, which of course is always done in arrears, so you've got to do a little bit of waiting. Healthcare qualification. So the main form here that you've probably heard of, if you've looked into this, is the Form S1 from the UK. This is when you reach state retirement age, not maybe your personal pension age or company retirement age, but state pension age, which has become a bit of a moving target, but for lots of people it's 67. Once you've got that, you actually have a right to get an S1, and that's where basically the UK picks up the tab for your healthcare costs overseas. And you'll get into the French healthcare system once, if you're a couple, one of you, the first one of you has got your S1, then you're both in as a household. Lots of people, however, are in a little bit of a gap. They might be retiring at 60 and they've got to wait till they get their S1. You do have to have healthcare cover in France, and there are a couple of ways of doing that. One, obviously, is to get private health cover. I'm sure there are people next door that can help with that. Puma is a new system in France, so if you work there, so I worked in France, 8% of my income went towards paying for healthcare. Wasn't encouragement to get some value out of it, but I mean that's what you paid. You paid 8%. So there is now a system where that you can actually pay 8% as though you were working there on your income, and that gets you into the system, which actually I think is going to look like quite good value for most people, because you've got your personal allowance, which is €9,800. You'd be paying 8% on income over that, and it excludes your pension income. So it's only going to be on, as you can see, investment income, interest, dividends, or rental income. So that you'd have to do a compare and contrast with private cover, but that's a system worth looking at. So again, sort of thing we advise on what's available. We don't actually advise on private healthcare, but we can. It's sort of thing that you should be aware of. And it's a sort of trap you can fall into, is not realising you need health cover, and you do. Not that social security, that again, if you're planning on going and setting up a business, then we can point you in the right direction, but that's the sort of thing to talk to an accountant, and I suggest you do need an accountant in France for if you're going to be self-employed, setting up a business. Post-Brexit, it's the same qualification system, but I don't know exactly how it's going to work after December 2020, but you're still right up until that point, it's the same qualification system. So don't worry if you are a year away, for example, from hitting state retirement age. Right now it's all exactly the same. You will still get the S1. It's all exactly as it always has been. Get to France, go to the mairie, get onto this carte de séjour. The taxes in France, I mean, just one point on that. Once you move over, if you're drawing pensions, then you will, not state pension, that's not there's no tax source on that. If you're having tax at source on, for example, pension income, then that will continue until you've been in France and filed a tax return and got a tax number. Once you can demonstrate to the UK that you've become resident somewhere else, you'll get a refund on the tax that you're paying in the UK, but you will actually, all of your taxes on that kind of income will become taxable in France. UK, we have a personal allowance over £11,000 now. It's £9,800 in France, so that's your nil rate band. I'm just going to highlight this first band. So you'll start paying tax a little bit quicker in France than you would do in the UK, because the allowance is a bit less, but it's only 14% rather than 20%. So that's a pretty good rate of tax. If you are a household, though, you file a single tax return in France. You don't have a situation. So if you have a situation where one of you's got 80% of the income, you won't have a situation where you're paying different rates of tax. It's all thrown into a pot and divided by 2. What's the benefit of that? Well, look at this band here. So up to this band here, €45,000. You're actually allowed up to. That's where you start paying 30% tax. €27,000, if you times that by 2, you've got about €54,000 of income that you could have as a household, and your top rate of tax is just 14%. So you'd be paying that times 2, €4,800 on €54,000 worth of income. That's a pretty good rate of tax.
Can I just ask a quick question on that?
Yeah.
Does that mean both of you have to be working, or they divided by 2 even if anyone of you works because you live together?
Yeah, well, you'll have some deductions taken if you're employed, like the equivalent of national insurance income, before you get to contribute, which are quite high in France. But you still file a single household return, yeah. So income tax will be divided by 2. However, that's income tax. There are some other taxes, and the worst case is 17.2% in addition to income tax. So if somebody was in the enviable position of having sort of 50,000 euros worth of share dividends, for example, and that was their source of income, then they're going to be paying 14% income tax, but they'll pay 17.2% in what we call generally a social charge. It's just tax. That's all it is. It sounds a bit cuddlier, a contribution sociale généralisée. It sounds like you're doing something good for your fellow man. It's just tax. Doesn't give you a pension, doesn't give you access to healthcare. It's tax on what we call in the UK unearned income. So that's part of our job, is to try and take as much of your income, your taxable income, away and not make it subject to this. So social charge was a temporary tax brought in to help reduce the national deficit. It's been there a very long time and it's going up, so it's here to stay. But it's not 17.2% on everything. So again, pensions, it's a bit less. Once you hit state pension age, it actually drops off on pension income. So I'm highlighting it because it's a potential sting in the tail if you are depending on your source of income. So don't just look at the table and go, right, we've got an investment income of X, that's our tax bill. Unfortunately, it's the previous slide plus this one. What income? If you've got a holiday home in France and you're not planning on taking up residency there, but you let it, you will pay tax in France on your rental income, and then you have to declare it in the UK. That won't be applied to many people here. But if, like most of you, you're actually planning on moving there, basically it's all the same things that are taxable in the UK become taxable in France. I'm just going to highlight two things. I did touch on them earlier. ISAs will be taxable. Premium bond winnings are taxable in France. They're taxed as bank interest. They see it as a variable rate bank account. It's not a winning that's tax-free. Pension income. Basically, there are only two things that don't become directly taxable in France, and they're government service pensions, so military, civil service, and rental income from UK property. Both of those are deemed to be fixed assets of the UK. UK gets first dibs on the tax, but you have to declare them in France. So very briefly, you had £20,000 worth of rental income or government service pension. That goes in the bottom of your French tax return. France says, right, we understand we're not going to get paid any tax on it, but there it goes. You've got another £20,000 that is taxable in France. You'll be taxed on it in the tax bands between 20 and 40, rather than 0 and 20, if that makes sense. It looks a bit like double taxation. It's not, because you keep your UK allowance, but yeah, that's actually how it's going to work. Your taux effectif, your effective rate of tax, is how it's worked out. UK does the same thing, by the way, if it was in reverse.
Does that change post-Brexit?
No, because that's will be a tax agreement. Most of the tax things, actually, Brexit really doesn't affect because they're direct tax treaties between the countries. It doesn't involve Brussels.
Yeah.
Okay. Right, I've just done that bit. The one thing here to highlight is this possibility of 7.5% flat rate on pensions. So if you become a tax resident of France and because of pension freedoms, you're now actually able to access, in the past it was 25%, you can now actually access 100% of your pension, assuming it's in the right place. And you do that as a resident of France where there's no possibility of a further payment, i.e. you've got to clear out the pension pot. You can do that, and there is a flat rate of tax of just 7.5% income tax. There will be some social charges payable on top, but not the full 17.2. You pay about 7 or 8% social charges on top. So that's another, again, it's a little soundbite for now, but it's the sort of reason that you might want to do a little bit of planning. Actually, yeah, okay, I do want to access a pension and make it a family, make it family money rather than just in one person's name. I just highlight that it is an opportunity. We've now known since June 2017 that your state pensions will continue to be payable. We were never in doubt of that, but actually it's confirmed that as long as you're living within the EU, they will also continue to be index linked. So, and that's exactly as it is now. If you leave to certain countries, South Africa and Canada being two, it's not index linked, but it's payable. We know that it will be. A final point on pensions, you've got all the same options. I'm not going to go through an annuity is and those options. The one thing that's different when you leave the UK is that you can actually move your pension money out of the UK to something known as a CUROPS, which is like an offshore SIP, a qualifying regulated overseas pension scheme. You don't have to move the money to France, but you move the trusteeship, the management of that pension out of the UK, and then you get out of UK rules and taxes. You'll still pay tax where you live, but often the flexibility that that brings makes things highly interesting for moving to a cure ops. Okay, 7.5%, yeah, 9% social charges if you do that before you are state retirement age and get an S1. So, I mean, by the way, if you accessed all of your pension fund as UK residents, it's taxed as income. 25% is tax-free, 75% would be taxed as income in the year that you took it. So, assuming it's a, if it's a six-figure sum that you're taking out, you're going to be paying 40 or 45% income tax in the UK versus significantly less in France. Right, given that you haven't got there yet, we'll just briefly cover the topic of dying in France. So sorry about that, but we'll deal with this simple. It's been touched on already. UK law is pretty straightforward. We only think of inheritance tax really in the UK because the law says you can do what you want with your money. You can leave it to whomever you choose. France has succession law and succession tax, and they're quite different, and the system's fundamentally very different. It's Napoleonic law, and reserved children have a right to inherit a share of your capital. One child is 50%. Remember it's 1/2, 2/3, 3/4. That's how it works, depending on how many children you have. More children you have, the less likely there's been a lot of money to leave. Anyway, I've noticed that. So it's less of a problem. Spouses have a right to at least 25%. I'm just going to touch on the rates of tax because those are. That's what's of real interest. And Brussels 4, that was the legislation that was mentioned earlier. You can use UK law. You'll still pay French succession tax, though. It's not a swerve around French succession tax, just the law. Okay, two bits to highlight. If you're leaving money to a child, the allowance is €100,000 per child. And then they'll pay rates of tax starting at 5%. On average, I think if you used a rate of 15 or 20% on say for like a normal estate, whatever that is, going to a child. So the rates are again a bit less in the UK, but you're going to be paying it earlier. If you want to leave money to a niece or nephew, there's only allowance of €8,000, and then they will pay 55%. The estate doesn't pay tax in France. It's the person that you leave the money to that pays the tax. And very much their relationship with you determines the rate of tax. Now this bottom bit here, stepchildren, of all the people that we've dealt with, hardly any have actually legally adopted their stepchildren. So a real, a very quick example for you is, let's say you've got a couple and one of you, or one of this imaginary couple has children from a previous relationship. If it's the parent that dies first and ultimately the children inheriting money from their step-parent, where they're not legally adopted, 60% tax applies after just €1,500–1,600. And that might be versus no tax or 5, 10, 15%. So that's so if any of that sounds a little bit like you, then I would suggest getting some advice. And do speak to notaires as well. Anything to do with property purchase, notaires will deal with, notaire solicitors will be dealing with. All sorts of family law, get some advice on that. It's money very, very well spent.